In one of my previous videos from a few days ago, I discussed how EA stocks had plummeted drastically since July of 2018. More specifically, their market cap, or the total dollar market value of a company's outstanding shares, peaked at around $45.42 billion on July of 2018 before taking a nosedive. Now, as of December 24th, 2018, the company's market cap lies at around $22.58 billion, the lowest it's been in 2 years and a drop of almost 50%. To highlight all this, I referenced the following article posted on website Seeking Alpha. One thing that I didn't mention then was that this isn't an official post by the website, but rather an article published by a contributor. This user does list in his profile that he has experience with senior management for a large retail chain, and that he managed multiple locations with sales in the low 7 digits. So he's familiar with economics, but what we're looking at here is one man's take on EA's financial prospects. Basically, the point he made in this article was that Battlefield 5's poor reception due to a less than authentic take on World War II, which contributed to the game's lackluster performance, may indicate that additional reductions in revenue estimates for EA can be expected. One of the centerpieces of this article was this chart showing a comparison between EA's stock price percentage change versus the Nasdaq composite level percentage change, with EA's dip being significantly lower. Regretfully, one very important point that I failed to discuss in my last video was the overall downwards trend of the stock market, of stock exchanges like Nasdaq, and of tech companies in general, a trend that greatly contributed to EA's own stocks falling. Essentially, the last video looked at this whole situation from a keyhole, but to see the big picture, it's important to discuss the current state of the stock market. Nasdaq, for those who don't know, is the second largest American stock exchange, and many of the companies under its umbrella happen to be tech companies, video game publishers being among them. Not all gaming and tech companies are part of Nasdaq, mind you. Sony, for example, is part of the New York Stock Exchange, but generally the major ones are listed under Nasdaq. While I'm certainly no expert of economics, the bottom line is that the overall stock market is currently in a fickle place right now, or free-falling, as some might put it. And this is happening for a variety of reasons. I won't get into specifics, nor will I claim that I fully understand the nuances of it all, but suffice to say that a domino effect of various circumstances in the current climate led investors to deem tech stocks a risky venture, resulting in many of them pulling out from tech companies en masse. And with Nasdaq being comprised of so many tech companies, it's the stock exchange that saw the biggest dip. Here's how one excerpt from a CNN article explaining the situation put it. Rising bond yields and interest rates are prompting investors to back away from tech, said Chris Zaccarelli, Chief Investment Officer for Independent Advisor Alliance. Whenever you see rates rise in a rapid fashion, you typically see tech take a hit, he said. As people start to get more concerned about the stock market in general, they pull back from more risky areas of the market. Zaccarelli explained that investors see tech stocks as a long-run asset. When borrowing costs go up, investors see their payoff move further away, so they turn to more reliable bets like utilities and consumer staples. Indeed, one look at market summaries for all the big tech companies right now will clearly reveal that EA isn't the only one affected by this. Companies ranging from Activision Blizzard, Ubisoft, Take-Two, Sony to Microsoft have all seen their stock price dip drastically over the last few weeks and months. Other giants under Nasdaq like Google, Facebook, Apple, Amazon, and Netflix are also facing similar struggles. While I'm sure many would take solace in the idea that EA's massive stock drop of almost 50% and their market cap dip of $22 billion was a result of karma and that this is a lesson in what happens if companies screw over consumers, it's important to understand that much of EA's recent stock price plummet has more to do with an ongoing stock market trend and less to do with controversies, consumer backlash, and their effect on revenue projections. That's not to say, however, that things like the lower than expected sales performance for games like Battlefield 5 after a string of PR missteps didn't enhance this downwards trend, this effect. If you look at EA stock and compare it to other video game companies, you will see that the drop percentage is significantly higher compared to the general trend. Whereas EA dipped by almost 50% in the last few months, other companies like Ubisoft dipped by 37%, and Take-Two Interactive dipped by 26%. As for Sony and Microsoft, keep in mind that they're not solely game companies, so it's not entirely the same playing field, but they are both part of the same industries being affected by the current trend, and their stocks only dipped by 22% and 17% respectively. Activision Blizzard, on the other hand, is in a similar camp as EA, with their stock price having dipped by 44% since their September 2018 peak. So while this stock market freefall is certainly afflicting companies all over, particularly tech ones, certain stocks are definitely dipping more steeply than others. And I'd have to surmise that the level of steepness, in part, depends on which companies are deemed riskier to invest in during these less than certain times. EA, for instance, has proven to be somewhat volatile with the general notoriety surrounding the publisher, leading to certain titles not selling as well compared to the competition lately. The poor reputation EA has built up over the years undoubtedly played a role in Battlefield 5's lackluster prospects, which contributed to the company's decision on August 30th to delay the game from October to November, after which EA had to lower revenue projections, which contributed to making EA look riskier in the eyes of investors amidst this cycle of stock market freefall, after which EA stock took a 13% nosedive over the course of 5 days. I should also point out that while FIFA 19 and its Ultimate Team mode continues to be EA's golden geese, there are signs that growth in terms of unit sales and Ultimate Team engagement are beginning to stagnate a little bit. In terms of sales, early reports suggested that physical launch week sales were down by around 25% in the UK compared to FIFA 18, and a more recent report from VG Charts suggested that FIFA 19 sold an estimated 4.3 million units in its first week compared to 5.7 million units sold for FIFA 18. As for Activision Blizzard, well, I don't have to detail the backlash they instigated by announcing Diablo Immortal at BlizzCon 2018 as the centerpiece of this fan celebration event. You'll recall that the announcement occurred on November 2nd, and the impact that the overwhelmingly negative reception had on Activision stock can be seen on this graph. In just 1 week, Activision Blizzard stock had dropped by a whopping 20%. Now, contributing greatly to this drop was also Activision's financial briefing, which took place that very same week, which reported that monthly active users across their games had seen its third straight quarterly decline, having dipped from 352 million users to 345 million. A big part of that can be attributed to Destiny 2's poor performance, which Activision admitted could not bolster its player base despite the launch of the Forsaken DLC, though growth of active users are likely stagnating across the board for Activision franchises, hence their recent initiative to cut costs and output games faster. Much like EA, while a huge chunk of this downwards trend can be attributed to the overall market being in freefall, there are definitely elements that compound that trend for certain companies more than others. Tech companies are already being seen as a risky venture in the current stock market climate, but some companies may be seen as riskier based on the perception surrounding them. So the main point that I'm trying to make with all of this is that the recent EA stock dip isn't what I made it out to be in my last video. Having failed to mention the ongoing stock market freefall, I made it seem like the dip was solely caused by Battlefield 5's underwhelming reception and commercial performance and the diminishing interest for EA games. But in reality, this isn't like the Battlefront 2 controversy that contributed in wiping $3 billion off of EA stock value. This isn't just a simple matter of the Battlefield 5 controversy wiping $22 billion off of EA stock value, of gamers having taught EA a lesson. This time it's definitely a more complicated situation, one that I admittedly can't fully grasp given my limited knowledge of the stock market. At the same time, I'd be hard-pressed to think that there isn't a correlation between companies whose controversial business practices led to lower sales or active users and companies whose stocks dipped at a much faster rate than those who weren't affected as deeply by controversy. We can see that game companies who haven't been touched as prominently by widespread controversy or lowered projections seem to be weathering the storm better. So no, gamers' protests against the EA shenanigans didn't cause this major stock plummet, though we certainly may have made it more difficult for EA and Activision to weather the storm. Once the stock market settles, however, do expect companies across the board to steadily recover their stock value as long as they show consistent revenue growth. As CNN's article on this matter put it, that doesn't mean the Nasdaq will continue to fall. Brad McMillan, Chief Investment Officer at Commonwealth Financial Network, said that the dip represents a normalization. Recently, there's been a tremendous amount of optimism about future growth baked into the Nasdaq's prices, he said. Now we're getting back to something a little closer to normal. In other words, once this dip hits its lowest valley in the not-so-distant future, it'll be prime time to buy stocks for all major tech and gaming companies with optimistic projections, meaning we are hardly looking at a situation in which the likes of EA and Activision are doomed or anything like that, though they are a little more wounded than others. So there you have it, folks. This is a very basic, surface-level outlook and clarification I wanted to provide about stocks dipping for all major publicly traded game publishers. The last video on this topic was definitely a little too narrow in its field of view, but hopefully this video paints a clearer picture. And I'm sure those who are more familiar with the stock market and with economics will be able to provide even deeper insight and clarify or correct certain things, and I would certainly welcome constructive feedback with open arms. So if you have anything important to add, feel free to reach out in the comments below or via the email address listed in the About section of my channel. With that, I would like to end this news update. Thank you for tuning in. To be further updated on all things gaming news, reviews, and discussions, stay tuned right here on Young Yeah. I'll see you guys next time. Young out.